Vertical spreads can be an excellent strategy for creating income. Because vertical spreads are limited risk, limited reward strategies, they're also relatively straightforward to manage. This video is going to demonstrate a couple of different approaches to entering vertical spreads for income. The main idea of using vertical spreads to create income is to profit from time decay. Remember, the Greek that measures the rate of time decay is theta, and since options that are closer to the stock price have a higher theta than options that are further from the stock price, we're going to sell an option that is closer to the current stock price and hedge our sold position with an option that is further from the stock price. Bullish vertical income spreads are constructed by selling a higher strike option and buying a lower strike option with the same expiration. A bullish vertical spread can be constructed using either puts or calls. The spread is going to be constructed using options with strike prices that are lower than the current stock price. So using calls would be an in-the-money trade, and using puts would end up being an out-of-the-money trade. Since out-of-the-money options are usually more liquid than in-the-money options, most retail traders prefer to use puts to create bullish income verticals. This trade is called a bull-put spread. It's also known as selling a put spread. That's the type of trade that we're going to focus on here. The type of stock that this strategy makes sense for is one that is neutral to bullish in a neutral to bullish market environment. The typical time frame for an income vertical style trade is anywhere from a week to 45 days. There are pros and cons to shorter versus longer time frames. Shorter time frames have a higher theta and therefore a higher potential daily profit. But shorter time frames are also subject to a high gamma risk and have a lower potential return on risk per trade. Now, there are many ways to choose which strikes you're going to use in a vertical spread. Let's examine two different approaches to bullish vertical spread construction. The first approach that we're going to talk about is using delta to help you select an option to sell. For an example, you could have a rule that says always sell an option with this specific delta, maybe 30 or 20. Or you could pick any delta to use. The key is to be consistent with the delta you choose. If you're using this approach, you shouldn't say, well, sometimes I use a 16 delta and sometimes I use a 40. You need to be consistent with your delta. The lower delta you use would give you a higher individual trade probability. A higher delta would give you a potentially higher return on risk per trade. As with any set of rules, there are pros and cons to this delta-based approach. The pros are that by being consistent with your delta selection, you should theoretically have a consistent win rate, and you don't have to worry about knowing which strike to sell, which makes your analysis easier. The biggest drawback to this approach is that sticking to a system that only allows a specific delta could turn out to be really rigid in certain circumstances. For example, you may see an opportunity to be more conservative or more aggressive in different situations, but a strict delta rule won't allow for that. Well, let's look at an example of a vertical income spread constructed using a delta rule. Here we have a stock trading for just over $363. The overall trend is up, the stock's pulled back, and it looks like a potentially good entry for a bullish income vertical spread. We're going to use a delta of 30 for this example. We can see that the put that has a delta closest to 30 is the 350 strike. So we're going to sell the 350 strike put. We're going to buy the 340 strike put as our hedge. In this example, we're using options that expire in 27 days. Our entry in this trade is a credit of $1.75 per share. That means the most we can profit is $1.75 per share or $1.75 per contract. In a vertical spread, when you get a credit, the most you can make is the credit you receive. The difference between our strike prices is $10. Now, If the difference in strike prices is $10 and the most we can make is $1.75 per share, that leaves $8.25 left over that we could lose. So in this trade, we're risking $825 per contract. That ends up being a 21% return on our risk in 27 days if the stock stays above $350. This is an example of entering a bullish income vertical spread using delta to determine our sold strike. Another popular approach to these types of verticals is to use trend, support, and resistance to determine your selling strike. There are also pros and cons to this approach. The biggest pro is that it allows flexibility. If you see an opportunity for a more aggressive entry or a more conservative entry, you could do it either way. It allows you to consider more flexibly market conditions and individual security analysis. The downside to this approach is that it might allow you to justify entering or not entering a trade based on your whims, and it might be less consistent than a set delta. In this example, we're going to use a stock trading for just under $300. The stock is in a long-term uptrend and has recently pulled back. There appears to be a fairly strong level of support around $295. Operating under the premise that there's a high likelihood of support holding up, you'd sell the $295 strike put. In this example, let's buy the $290 strike put as our hedge. We're going to use 27-day options. Our entry in this trade is a credit of $1.33 per share. That means the most we can profit is $1.33 per share, which is $133 per contract. The difference between our strike prices is $5. That means we're risking $367 per share, or $367 per contract. That ends up being just over a 36% return on our risk in 27 days if the stock stays above $295. Well, that's an example of entering a bullish income vertical spread using trend, support, and resistance to determine our sold strike. The next question you may ask is, how wide should I go with my strike prices? We can give you some basic guidelines to experiment with while you're virtually trading to figure out what style works best for you. Generally, income verticals with a larger distance between the strike prices have a higher theta. That means they earn money from time decay faster than narrower strikes. The benefit from that is that if your forecast is accurate, you can exit the trade quicker at your profit target than if you used a narrower spread. Wider verticals also have more exposure to volatility and usually a lower return on risk. Narrower spreads usually offer a higher return on risk, but much lower exposure to time decay and volatility. This means that you normally would have to hold on to a narrow vertical spread longer to realize your target profit than a wider vertical spread. To begin using vertical spreads, come up with a basic set of entry rules to follow. You can use the examples provided in this video to help you get started with your virtual trading. Be consistent with your entry techniques, and then watch the videos on vertical trade management to study how to properly manage these trades.